Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 379 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today we are going to be talking about international investing, right? Very often we talk about investing, we're talking about the S&P 500, we're talking about U.S. stocks, we're talking about U.S. investing, domestic investing, right? But today we're going to talk specifically about international investing, the benefits that it can actually bring us, what the returns have looked like over time, and whether it is a good idea or not for your portfolio. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards our long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, let us be clear about something. There is one thing that as investors, and especially as investors in the United States, that we do not do well, right? And we do not do maybe as much as we should. I would go as far as to say we don't do it as much as we should, right? And that is consider international markets, right? Very often we get caught up in our own little world. We get caught up in the S&P 500, and we get caught up in the Dow Jones, and we get caught up in the NASDAQ, and we get caught up in all these American growth companies. We get caught up in all these things, and very often we forget to think about the international companies. We forget to think about international investing at all. We forget about international stocks. We forget about international bonds. We forget about different ways that we can invest in an international way. And for those of you who don't know, right, I teach at the college level, right? I teach an international finance class, as a matter of fact, right? And a lot of what we talk about is, investing in international markets, exchange rates, all these, inflation, inflation in different countries, exchange rate changes, interest rates in different countries, all these different types of things, right? And it makes me think a lot about international investing. And hopefully I can convey a little bit of this to you today, right? As to why we may think about international investing. And typically there's two reasons, right? Two reasons that people would want international investment exposure. And those reasons are quite simple, right? One is diversification, and this is by far the biggest reason, right? International investing can help investors in the United States spread your investment risk, right? Diversification is just this big word that means don't put all your eggs in one basket, right? Don't take everything and put it in one place, because things in one place are going to be highly correlated with one another, right? So if one thing goes down, they all go down, or if one thing goes up, they all go up, which can be great when things are going up, but it's terrible when things are going down, right? So we diversify, right? We invest in things that are different, right? In order to decrease the amount of correlation among the returns of the assets that we hold, right? So let me give you an example of what diversification looks like, right? You may hold large stocks in your portfolio. You may hold large cap U.S. stocks in the S&P 500. Well, you may also choose to hold small and mid cap stocks, right? Which would allow diversification among the size of the company, right? You may also diversify among the type of company, right? Is it a growth stock, meaning high PE, high price to sales, high multiple stock? Is it that, right? Or is it a value stock, right? Does it have low multiples? Is it paying a dividend? What are we looking at there, right? You can diversify in that way, but you can also diversify among domestic, right, and international stocks, which is extremely important to understand, right? This is another way that we can decrease our investment risk and potentially add to returns, which is the second chief reason why people would invest in international investments, and that is the growth that they can take advantage of. Okay, international investing takes advantage of potential growth in foreign economies, particularly in emerging markets, right? Emerging markets being markets that have not been greatly developed, but the fact that they're not greatly developed can leave them very open to some explosive growth, right? Which may be a reason why you want to, dip your toe into an international allocation. Now, these are our two primary reasons, right? But there are many, many, many risks associated with international investing, right? And those risks need to be known, right? If I'm going to sit here and talk about investing in international markets, you need to understand that there are different risks than there are in just American investing. So let's talk about a few of them, right? Access to different information, right? Many companies outside the United States do not have to provide investors with the same type of information as U.S. public companies, and the information may not be available in English. Now, that's not to say we can't Google translate it, right? But that is to say that you may not get the same level of information, the same type of information, the information that you need to do the proper analysis that you would among U.S. companies, right? Which can be frustrating. And it may lead you to not be able to make an investment decision and keep from investing at all, okay, which is a problem. Then the cost of international investments, okay? International investing can be more expensive than investing in the U.S. Now, a lot of these things that I'm going to talk about here, a lot of these risks, right? They do not apply to index investing. They do not apply when it comes to broad diversification among international assets, okay? They apply more specifically when you're trying to buy individual assets on the international level. But the costs are still higher, right? They may not be crazy high with an international index, right? You can find cheap international indexes, which I'll talk to you about here shortly, right? But the cost is still going to be marginally higher than the cost for U.S. investments, okay? Then working with a broker or an investment advisor, right? If investors are working with one of those two, they should make sure that the investment professional is registered with the SEC or with the appropriate state regulatory entity, right? If you're working with an investment advisor, that is doing international things, or a broker doing international things, you want them to be on the up and up with the SEC. Then one of the bigger risks, right, which I talk about in my class quite often, is changes in currency exchange rates and currency controls. Okay, you may not think that this is a big deal, but this is actually a very big deal when it comes to investing in international markets. Okay, when the exchange rate between the dollar and the currency of an international investment changes, it can increase or reduce your investment return, right? You may say, oh, this company has made, 15% per year nominal returns, right? Just the returns that they make over the past 10 years. That's great, right? Well, yeah, maybe that's great, but has the dollar appreciated or depreciated relative to their currency? Or has it changed much at all? In addition, some countries may impose foreign currency controls that restrict or delay investors or the company invested in from moving currency out of a country, which can again be a problem, okay? Then another risk that you have to consider when investing in international markets are changes in market value. All securities markets, including those outside the U.S., can experience dramatic changes in value, and maybe even more so based on the liquidity of the market, meaning the amount of shares that are bought or sold and the amount of cash available in the market. Because if there's not a lot of liquidity, then there can be large swings in the market, right? And the inability to stop some major crashes at any given time, right? So the changes in market value may be dramatic. And this brings me to another risk, which is the different levels of liquidity, right? You may have lower trading volumes and fewer listed companies than the U.S. markets, right? And they may only be open for a few hours a day. So some countries, they restrict the amount or type of stocks that foreign investors may ultimately purchase, right? Which can decrease your ability to do proper investing or trading in the way that you may want to in international companies, right? Then some very big risks here are political, economic, and social events, right? It's difficult for investors to understand all the political, economic, and social factors that influence markets, especially those in countries that you do not live in, right? So that can impact returns in a very real way, and it can impact the analysis that you do on your investment. It may be a new layer of analysis that you may have to learn to do that can be very problematic if you don't already know what you're doing. Okay, then another risk is legal remedies. So if U.S. investors have a problem with their investment, they may not be able to seek certain legal remedies in U.S. courts as private plaintiffs right? Even if they sue successfully in a U.S. court, they may not be able to collect on a U.S. judgment against a non-U.S. company, right? They have to rely on legal remedies that are available in the company's home country, okay? Now, all of these are very much reasons why a lot of international investing is done in other developed markets, right? In other markets that we have a general reason to believe that your investment is going to be potentially safe, right? But especially investing in emerging markets, smaller markets, places where growth can be more explosive, there can be a lot of these issues that you don't run into in American markets, right? So taking those risks into account are very important, right? If you take your proper risk into account, then you may look and you go, international investing is just, too much risk, too much understanding that I have to have. Maybe, right? Maybe it is, especially at the individual security level. You might not want to buy individual stocks in international companies or individual bonds in international companies. And I would understand that, right? But maybe you can deal with the risk of an international index, right? Which again, we'll talk about here shortly. But kind of along that same line, how can we invest internationally, right? We understand some of the risks. We understand why we may do it, right? But how can you do it? How do you invest internationally? Many of you may not have any idea, right? And these are things that I teach all the time. I think it's very interesting. Some of these I think are very useful to a lot of us, and some of them I think only in specific situations. But the first of these types of investments that we can hold are called American Depository Receipts, right? These are ADRs, okay? Now, the stocks of most non-U.S. companies that trade in the U.S. markets are traded as ADRs, right? Each ADR represents one or more shares of foreign stock or a fraction of a share. If investors own an ADR, they have the right to obtain the stock it represents, but U.S. investors usually find it more convenient to own the ADR. The price of an ADR corresponds to the price of the stock in its home market, adjusted for the ratio of ADRs to the company's shares. Investors can purchase ADRs that trade in the United States through a U.S. broker. So basically what happens is you have some custodian, some broker, right? Somebody, right? The TD Ameritrade or Fidelity or Schwab or whatever, who holds the shares of these international companies, right? And then they take these ADRs, these depository receipts, and they will sell those to their U.S. investors. And the investors hold these depository receipts, and they're as good as the shares of stock, but they are not the full ownership. And in some cases, they do not give you the rights that ownership of the stock would typically give you, like in the United States. Okay. But this is extremely common. ADRs are quite common, right? Some of the biggest Chinese companies that you could think of, for instance, Alibaba, right? If you want to invest in Alibaba, you can buy their ADR, right? If you want to invest in, I think Tencent stock, that's correct. They are also an ADR, right? I'm not going to push my luck too much, right? But another Chinese company, JD, that may not be an ADR, okay? But nonetheless, right, investing in ADRs in the United States is very available to us, but we have to make sure that we do the due diligence on the company, take into account the proper risks before we ever invest in these. And these are individual securities. So this would be like buying an individual stock, right? And buying an ADR. So this assumes that you're in the place where you would buy individual stocks anyway, okay? But for the vast majority of us, these next types of investments are going to be the way that you would get international exposure. And it is the way that I myself get international exposure. Okay. I've bought some ADRs in the past in my individual stock investing, right? But as of today, I would say as of today, the only types of international investments that me and my wife hold, right, are these next few types. So the first would be through U.S. registered mutual funds, right? So one way to get international exposure is through U.S. registered mutual funds. Mutual funds may provide more diversification than most investors could achieve on their own, and they're subject to U.S. regulations, which protects investors, right? We like that. We like investor protection, okay? Now, there are different types of funds that invest internationally, right? There are global funds, which invest primarily in foreign companies, but may also invest in U.S. companies. So a global fund may be something like a total stock market index, right? Which may take into account everything, or a world index. So I think Vanguard has a world index fund. And yes, so the Vanguard Total World Stock Index Fund, which is the VTWAX. I'm sure there's an ETF version of that fund as well if you're interested in it. And the reason I talk about Vanguard so much, that's where many of my accounts are. All right, and so the investment allocation here, let's see, is actually 63% North America, 10% emerging markets, 16% Europe, 10.6% Pacific, 0.2% Middle East, and 0.2% other. Okay, so that would be their allocation, and many of their largest holdings are U.S. companies. Okay, actually, their 7 largest holdings are Apple, Microsoft, Alphabet, Amazon, Tesla, Nvidia, and Meta, which Facebook. And then Taiwan Semiconductors, number 8, and then 9 and 10 are Berkshire Hathaway and JP Morgan. Okay, so most of your returns there do come from U.S. companies, but you are going to get broad-based diversification into other countries, as I said there, right? Still only 63% North America, so you do get 37% that is ex-North America, which can provide some good diversification, right? So that's one way, right? A global fund, okay? But then there are also international funds, which limit their investments to companies outside of the United States. So you may say, okay, what may this look like? So again, I'm going to stick with my Vanguard, right? So we're just going to look at an international fund. So Vanguard has the Vanguard Total International Stock Index Fund, which is VTIAX, right? Which is the mutual fund. Again, there's also an ETF that is correspondent with that, right? And if you look at that portfolio, that is only going to be 7.1% North America. So my guess there is that it may be companies in Mexico or Canada, and then 25.2% emerging markets, 40.2% Europe, 26.9% Pacific, 0.5% Middle East, and 0.1% other, right? So that's going to be not U.S. companies. So you could also diversify in that way and invest in international funds like that. And I'll use that as an example here shortly when we talk about the type of returns that you may expect. Then there are regional or country funds, right? So they principally invest in companies located in a singular geographical area, right? So you may see, total international funds, but you may also see something that I'm pretty accustomed to is seeing Asian funds, right? So you can look for like an Asian index fund, right? And you could find one. And here I'm seeing an ETF that Vanguard has, which is the Vanguard FTSE Pacific ETF, right? So it's going to get you a lot of Asian type companies. And you go to the portfolio management and it just says 100% Pacific. And you see their top holdings are like Samsung, Toyota, Sony, right? A lot of Japanese type companies. So it only makes sense why that would be the case. Now, you can also invest in international index funds that maybe, have specific foreign markets or specific markets that you're trying to track, right? So this may be, kind of an overlap with the total international funds, or maybe an overlap with some of the country funds, but you may be finding specific markets that you want to invest in, and that could work as well, okay? And there's a ton of overlap there with the U.S. registered ETFs. I hold some of those as well. And like I said, a lot of those mutual fund index funds I was talking about, you can also find as ETFs. There's maybe some more tax advantage to the ETF, and then obviously you can trade it throughout the day. Then there are also U.S. traded foreign stocks that you can invest in. So although most foreign stocks trade in the U.S. markets as ADRs, some list their stock directly here as in their local market, right? Investors can purchase U.S. listed foreign stocks that trade in the U.S. through a U.S. broker. And then obviously you could trade in foreign markets, but that's going to be a bit trickier, right? So that's how you could get, diversification internationally, right? But let me talk quickly. I say quickly, I'll take a few minutes here. But let me talk about the returns that you may expect and why we underinvest in this place. It's not so much that we just don't understand, but for a long period of time, the United States has outperformed many of the other markets, right? And it hasn't been long that we've had access to all of the emerging markets that we have access to today, right? For a long period of time, we only had access to U.S. investing, and then markets have opened up more over time, right? And you invest in what you know, right? You invest in what you understand. So let's say that I just stack up three different funds here. So I'm stacking up the Vanguard Total International Stock Index Fund ETF. So I'm using the ETF version here, right? That is the VXUS. And full disclosure, I do hold that ETF in some of my investments, right? Then there's the Vanguard 500 Index Fund ETF, which is the VOO, right? Again, full disclosure. And then there is the VWO, which is the Vanguard Emerging Markets Stock Index Fund ETF. Again, I hold all of these in some form or fashion in some of my accounts, okay? So you take these and you stack them up on top of each other, and let's just look at 5 years, okay? Because these funds have been around for different lengths of time, it's not fair to go back way too much further, right? But let's say we go back 5 years, okay? You go back 5 years, the S&P 500, the Vanguard 500 index, is up 105.6%. So you could have just over doubled your money in the Vanguard 500 index. Fantastic, right? Great returns. What about the total international index? You would have only been up 33.67%. So a little less than a third of the return of the Vanguard 500. Well, what would you rather be invested in? Something that's going to make you higher returns or lower returns? Something that you understand more or something that you understand less? Something that you see going, on the bottom line of CNBC every day, or something that you don't, right? Obviously, the Vanguard 500 is going to get a lot more inflows, right? And it's the largest ETF in the world the largest fund in the world for a reason, right? Then there's also the Vanguard Emerging Markets Fund, and that's made about the same as the total international index. It's actually lagged by a little more than 1%. It's at 32.65% over 5 years, right? So that tells us that developed markets have had higher returns in that total international than did the emerging markets, right? My point here is that yes, you would likely have made lower returns, and it may be true in the future that you'll continue to make lower returns. So what's the point, right? What's the point of investing in some of these markets? The point is that markets mature and that diversification helps, okay? So what do I mean? Markets mature. Well, markets don't stay high growing for a long period of time. I say not for a long period of time. They don't stay high growth forever. Right? The U.S. is not going to stay high growth forever. That's just fact, right? Stocks, companies that stick around in the U.S. are not going to stay high growth forever. And that doesn't mean it won't continue in our lifetime. It may continue for the next 1,000 years. Who knows, right? But it won't happen forever. And we've seen it in other countries, and we see it in our own country, right? The growth of our GDP has declined substantially in the past 100 years compared to what it used to be, right? We see countries like China and India that grow much faster than us. Now, that doesn't mean that we don't have very business-friendly markets and that our markets aren't the best to invest in. It's all very true. But the ability for the underlying fundamentals of the companies to grow over the long term may not be as great here as they are in other markets, which leads you to be like, hey, maybe these other markets are worth investing in, and maybe it's worth doing so, at least in a very diversified way through a fund or an ETF, which is why I do it that way. Right? Then obviously diversification, right? You can decrease risk in your portfolio, okay? Just because U.S. stocks have blown out over the past, 10, 12 years, whatever, right? Just because they've blown up doesn't mean that international stocks have. In fact, quite to the contrary, right? We can even go back to, let's say, around this time last year, right? Let's just go back a year and let's talk about stock returns in these three funds over a year. Right, S&P 500, 1 year, 23.11%. The Vanguard Total International Fund, 2.53%. The Emerging Markets Fund, down 4.73%. So other than the underperformance, what's my point? My point is that stocks may go down in the United States because stocks have been so great, right? But that doesn't have to be the case for these international stocks. They can provide diversification. They can provide some uptrend in your portfolio when the United States may be on a downtrend, right? They can provide less correlation among returns over time, which can be useful. Now, am I saying that you should hold nothing but international funds? Absolutely not. Am I saying that they are 100% going to outperform moving forward? No, I am not. What I am saying, though, is that a proper allocation to international funds, to international stocks, I'm talking about international stocks here, even international bonds, it's also useful, right? If you are investing in the bond market. It can be useful because you can decrease the correlation of what you're investing in and potentially have higher growth in the future, right? And that's what we want. We want diversification. We want growth, right? We want lower correlation, and we want the ability to find things that are going to increase in value more over the long term than what we are currently invested in, okay? So even though you may not be fully well-versed in all international things, maybe do a little research, right? Look into some of these risks that are, maybe worrisome to you. But understand as well that U.S. registered mutual funds are held to task about what they're invested in, right? Buying these Vanguard funds, buying Fidelity funds, buying all these different fund families. I know I've talked about Vanguard, but I'm not just pushing Vanguard. That's just what I use and what I know, right? But those funds are held to task. It's not like investing in international things is just going to create this huge bust in your portfolio, right? Again, there's going to be high diversification within the funds. And then also, I'm not suggesting you hold that as your only thing that you hold, right? And you may do this in a very simple way. You may not hold a bunch of different ETFs or mutual funds. You may just be holding a global or world fund, right? That holds a lot of the US, but also a lot of international funds. You may hold a total stock market index or an extended market, whatever, right? You may hold all these different types of indexes. The point is that international allocation can be useful, right? And I would suggest that you look into it. You see what the usefulness can be in your portfolio. Maybe you've already got it licked. Maybe you've already got it taken care of. Maybe you don't think it's necessary in your portfolio. That's fine. Maybe you're okay with the returns of the S&P 500 and you just want to keep putting money there. That's probably a good long-term plan, okay? But that doesn't mean that you can't refine your plan, make your plan a little better, and increase your investing performance over time, increase your diversification, decrease your risk over time. And I think international stocks and international bonds, just international allocation in your investments, can help you a lot to do all of those things and to have a more well-rounded portfolio that may be better for you in dark times, especially dark times in the United States stock market. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who watches or listens to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.